All right, hello, my good friends in Traderland or any land that you come from. I don't care. Welcome. This is Doug with thelincolnlist.com. Today, I want to get my education on. I want to dish out some education your way, but only on one condition, guys. You got to make me a promise here. If I'm going to do this, you got to make me a promise, and that promise I'm asking is that you're going to try your best to use this education to make some money. Now, maybe you don't get it right. Maybe you don't make as much money, but I want you to just say, look, I'm going to put forth the effort. I'm going to take the tools and the resources that you're going to tell me right now, and I am going to try my damnedest to make money. That's all I ask. That's the only reason why I do these videos. So here's what I want to talk about, because I think this is a good topic for today. Should we buy this dip, guys? What do you think? Should we buy this dip? I mean, in the past, seeing stuff like this has resulted in making enormous amounts of money. Traders and investors have been right when they've stood in front of the freight train of selling because the result's been a new all-time high. But what about this one? Is this one the one that would be different? Is this the one that might be like a 2008 and set off this long-term correction in the markets? You know? Or will it be like December of 2018 where it was just panic that ended up resulting in all-time high? We're going to find out. So let's talk about when should we buy this dip, because you know there's going to be a bounce. Now here's the problem with trading contrarianly. Is that even a word, contrarianly? Or trading against the grain. Bouncing trades, going against the trend, let's say. I don't like to use the word trend. Let's just say counter trading. We'll say that. The thing about this, where a lot of traders, investors make the big mistake, is it's on the presumption that just because something is down a certain amount of points or a certain percentage, that it is entitled to bounce or it is entitled to be sold off. And that is incorrect. As most of you know, the saying, the market can remain irrational longer than you can remain solvent. So sell-offs can get longer and farther and more devastating than you can imagine. Same way rallies can last longer than people ever want them to. So you just never know. Now, when something like this happens, there's one thing that we all know, and that is the market is going to bounce. You're not going to continue to sell off like this with this much aggression and this much volume every day for the rest of the year. We all know that. Now, the thing is, when it comes to timing an event like this is where a lot of traders, investors go wrong, is they try to pick the perfect bottom, or they try to step in front of it when it has yet to really establish a low. Now, I've done a couple of videos about how to do reversal trading, and I want to share with you in this case what I'm specifically looking for, because one of the things I'm not going to do is try to draw a line and say this is gospel, this is where it is going to bounce. How I come up with this is I use my favorite tool, which is support and resistance. In this case, it would be support. I try to find some areas of value where you are reaching epic levels of potential support, where you're going back so far to where the market has proven itself time and time again that that's been a support area, a bounce area. I'm looking for those deep levels, and I'm wanting to see if they get tested. Now, in the back of my mind, with technical analysis, one thing you got to understand, guys, is it always depends on the dark cloud that's overhanging it. If we're talking about a trade war, that can dig deep into a market sell-off, and we saw some of those. But the thing about the trade war is the economy was still doing well. Companies were still reporting good profits while the trade war was going on. You know, that stuff was still going well. And the consensus was they'll come to an agreement sometime. So there was nothing really dampening the spirits of traders and investors. Here's a different story. We have a somewhat of like something we saw years ago with the bird flu. Bird flu. And you have these viruses like this coronavirus. This could be a wild card that just destroys technical analysis. No one can ever think that technical analysis is just gospel in itself. You have something here, and what I mean by that is if you're looking at a beautiful area of support and the market looks like it's going to hold, but then all of a sudden a report comes out that a high school's quarantined 250 students because they're all choking to death from coronavirus, you can bet your damn ass this thing's going to roll right on over and smoke out. So you always have to be prepared. And right now, the way the market's reacting is going to be headline sensitive to this because reports keep leaking out every day. And right now, the market doesn't know the extent of this. You hear the words, it's under control, but maybe it's not, until that dampens, that news, that tone has to dampen. And here's how I look at this with my eyes, judging the tape, using technical analysis. And it's always important, guys. You can't just make it in technical analysis. You have to have smarts when you're trading. You have to have the screen time. You have to look at this stuff over and over again. And that's how we become successful. You learn through doing and experiencing. So here's how I'm going to look at it. I don't have to be the first person to buy this particular dip right here, okay? I don't, because we're down so much at this point that there's plenty of room to rally. I don't have to try to be the hero because there's no style points in trading. That also means that not only do I have to try to pick the bottom, I don't need to worry about that. I also don't need to worry about chasing myself with a rally. If I feel like I missed a couple of candles or a big old spike, that doesn't necessarily mean that I've missed the meat of the rally. Because if we're talking about a potential rally that could retrace back up to, let's say, 324, 325 on the market, the SPY I'm looking at, going by this one, a couple percentage points, then we've got plenty of time to get into the trade with size at the right time to make big money. We don't have to sit there and nibble on the bottom and take our rublets and scalps. We don't have to worry about that. We can do this right. So here's what you're looking for first. I always like to go look for some support areas to try to get some ideas in my mind where this market might bounce. And I'm looking at two numbers right now. One of these would be the pivot low where you had not just support from the 3rd of December. Right here, you see it, 3rd of December. But you also had a bunch of clusters going from November 6th of last year through November 14th. So when I said earlier it's about picking specific areas where the market has shown time and time again that there's rock solid support, right there's a good number because you had a span of it lasting a week or more. In November, you had a retest of it from December, and it solidified that, and then it moved on. So where you sit now, you're not too far away from that. You're sitting here at 311, 16s, and whatever. It's down at 307s. Also, just slightly underneath of that is the 200-day moving average. This is also a very important number. We haven't seen that test until we go all the way back into May of last year. So these are big time levels. So what I'm looking at first is if we continue, let's say tomorrow, as you're looking at this, tomorrow this thing rolls down into those numbers, I would expect a bounce there. Now, just because it hits those numbers doesn't mean I'm going to just dive right on in because I expect a bounce. I will need to observe what the action looks like that. Now, I'm going to try to describe this to everyone, what I mean by action. I'm looking to see if people want to buy the dip. And let me show you what I'm talking about. So today this market's selling off and you have this first little test right here of support. Just tiny little support right here. You get one bounce, but look at the volume here. It's actually decreasing while the market is bouncing. Like the volume is going down while the market's going up. Now, you don't need to be a rocket scientist here, do the moving average, draw the lines. You just look at it with your eyes. And it's basically telling you one thing is the only thing that you need to know. And that's the market's not really that interested. So kind of put it on a scale of 1 to 10. How interested are they in this dip? Give them a 3. It's a lame attempt at trying to pick up the dip. So then what has to happen? If the dip doesn't get bought, the market needs to go lower to find another area where you can get some buyers. So can kind of consider the market like this human on a quest to go find people. Like it's got to go find some buyers. You got to go look somewhere else. So it comes down here, finds another spot, same thing. Decreasing volume, no one's interested, lame bounce, recycles lower. It isn't until the end of the day you start getting a little bit of volume. So pretty much the entire day, every dip that hit a level got supported, but the support was so weak that it didn't instill any confidence for most buyers to go, look, this is the bottom. It's not showing me that here right now. Plus, every time it rallies, it keeps getting washed out and making a new low until the end of the day. So when you're looking at this stuff, and I said screen time, that's the things that you learn while you're trading over and over again, is how these things behave. So the first thing I'm going to do is not just net, I'm going to look at these numbers down here in this area right here. And this 200, never mind drawing this, somewhere on this spot right here. And I want to see if there's a lot of volume that comes in and bounces off this number. Now, just because it bounces off there doesn't mean I'm right in at that point. Maybe I want to see if it holds that bounce, if it can build. And when I say build, I'm talking about like an event like this that bounces, maybe trades sideways for a little bit, then re-gears and trades sideways, really confirming that buyers are starting to feel more comfortable and they're putting more money to work. Remember, we don't have to be here at the very bottom. So that's one of the things I will look at. So in an ideal scenario, as I'm doing this, it's the 25th, Tuesday the 25th. So you might be watching this on Wednesday the 26th. You might be watching it next year. You might never even watch it. I don't know. But I would be looking in an ideal scenario to begin Wednesday, selling down into those numbers. And I think the reason why you need a capitulation sell is to shake every one of the early dip buyers out, capitulate everyone on their positions, strike the maximum amount of fear into people. Then you'll see the biggest, most ludicrous, I'm saying that word all the time now, ridiculous bounce. That's where you're going to get the most violent, strongest, fastest recovery. That's number one. Now, we all know stock market trading has a beautiful way of taking plan A and pooing on it, right? Like my plan A. What about plan B? What if that doesn't happen? What if it takes off tomorrow and this is the low? What if this is it right here? It's a good question. We have to prepare for that. So here's how I would look at the scenario number 2. If you don't gap down, let's say you gap up, which is exactly what happened today. Gap up. Now, here's the problem with a gap up. It causes FOMO. So a lot of the issues that you had today, the 25th of February, was the fact that the market gapped up 100 points. Everybody was so conditioned and accustomed to buying the dip. They're like, damn, I don't want to miss this rally. I'm diving in. They dive in and down it goes. And they got no choice but to stop out, which is compounding the sell-off because they're FOMO'd and they're conditioned to do that and it doesn't work. And, you know, things like that happen when you trade stocks. So if we gap up, we can't really say, all right, we never reached max support. So maybe this support I'm looking at or this bounce can't really be trusted. Now, a side note, as a trader, that doesn't mean you can't trade it. But this goes along, this is a completely different topic. I'm just going to throw it out there for you guys while you're learning. You can watch it back over and listen to it. But one of the important things about understanding that is that also dictates position size. If you get the tier 1 setup that you're looking for, the the limit down there into those levels, I would be willing to put more size there. If you gap up, I'm not going to chase the gap early, but I'm also going to lower my position size because I'm not going to be so enthused about that because I'm not sure that that's established bottom just yet. So let's say it does gap up. What you're still looking for at that moment is, first thing, don't chase the gap. Maybe you miss it and it just keeps running and running and running. That's just the way it goes. But I think early on you couldn't really trust that first thing. Monitor the first couple of pullbacks. Remember, don't worry about chasing the damn thing if you missed it by 100 or 200 points. It's down like 2,000 over the last, 2 days. It's not something that you can be really late to the party. This is the beauty of it. You can be really late to the party and still make some significant bank. You don't have to be the first one at the table. Just be patient. That's what you got to do. You got to be patient. Wait for that move. Wait for it. Wait for a few back tests because trust me, it's going to be volatile. If you go back and you look at the most recent ones that we've had in last August, same thing happens here. Once this market rolls over, it spends about 1 month just back and forth, going back and forth, back and forth, back and forth. Same thing back here. It spends some time going back and forth before it really could rally. See, it just goes up, down, up here. So I would expect a couple of weeks of choppiness. You'll get some panic rallies. You'll get some selling. The stuff that you're looking at is going to have extended ranges on them. So just remember that. You don't have to be the first one. If we gap up, what I would be looking for here is a couple of pullbacks to really solidify that this is the low for now. Now, when I say for now, that might mean as a day trader just today. Just get me through the day on a spike. I don't care. As someone who is swing trading or investing, It depends on your time horizon. What are you investing for? Are you Momo trading, swing trading, short-term trading, overnight trading, or are you if you're like a long-term investor, don't worry about it. If your time horizon's 10 years, this is nothing. I'm just talking, just turn this video off. This means nothing to you. Just buy. But if you're somebody that's looking for short-term, you got some positions in mind, pick spots. If it's not the market like I'm showing you here, just pick a stock. Pick some areas where you have solidified support. The further you can go back, the more important that it is. Put together a plan that if the market sells off into those numbers, don't just jump in at them. Unless you got a big account, you can take a nibble and add, but just don't worry about that right now. Look at those and then pay attention to the action if it gets there. When the market does bounce, pay attention to the way that it is bouncing. Is it putting together consistency, candle after candle? Is the volume coming in strong on each one of those candles? Or is it going up and then pulling back and going up and then pulling back? If it's doing that, it's going to be hard for you to stay in because you're just going to because it's too undecisive. It's going to be too volatile and it's not going to give you the clean read, and you're probably going to get stopped out or you're going to give up on the trade, and then an hour or two later, it's going to roll. And you're not going to be in it. So if we gap up, let me just kind of go through this and make sure I got everybody on the same page because I've ranted so much here. I don't even remember what I was saying. That's what happens when you're my age. Anyway, ideal scenario. We gap down, you get into those. And guys, you'll only love these gap downs a lot. They're beautiful things for traders to make money. Because who wants to buy everything at all-time highs, right? You need pullbacks. Pullbacks allow all of us to get back in to these trades. So you want to look for that. Pick your stock. Pick your favorites. Pick the things you want to own. Get your shopping list out. Pick good supports. Set alerts. See if you can get that baby with the bathwater flush out and get in this and get in the stocks. Look for support first. Look for volume. Look for the pace of the selling to slow. You want it to slow down. Slowing down means it's getting exhausted and people are tired of selling and sellers are no longer around. They've already gotten out. When you start seeing panic flushes and extended candles, don't step in front of that. Just look for the slowdown. Let it slow down, let it build and create a new level to work from, allowing you to put risk parameters in place. The next one is the gap up. Rule number one, do not chase the gap up. Maybe you'll come back and say, dude, you cost me a lot of money because I could have chased, but that's a bad habit, guys. Over time, you're going to thank me for not chasing. Don't chase the gap. Let it pull back because it will, because people are going to want to sell into the first couple of greens. Let it settle down, pick some good areas that's developed support, and start making your trades and putting your risk. One thing to understand, though, here is do not underestimate the power of how strong the rally can be. Don't write off a 500 point up day. Don't just step in front of this nastiness and try to scalp it for 33 cents or 50 cents. You know, I know that's a good trade and it can be a good trade, but you know, you can scalp any day of the week. You don't have to step in front of this madness and headline risk just for a cheesy 50 cents. You want to sink a trade like this because you're trying to get $5. You're trying to get 600-700 points. You're trying to really nail one, but you've got to be patient. So anyway, I'm going to leave it on that note. Just remember what I said. There's going to be two scenarios. You're either going to flush out, gap down, and flush out into those numbers and probably bounce. You know, providing there isn't any more sickening headline news that's just terrible, or you're going to get a gap up. Be cautious of the gap up, but that doesn't mean I would expect we see a pretty solid rally in the next couple of days, especially as we progress towards the end of the week. Key is just let the market shake itself out. It will give you the sign. If you just look at it and try to listen to what it's telling you, it'll tell you what it's trying to do. Anyway, guys, thanks for watching this video. I hope it helped. Keep your promise. Try to make some money on this. If you do, visit thelincolnlist.com. Click on the Trade Room tab. Trade with me. I'll walk you through this. As always, if you liked the video, click that you like it. Thanks for watching. I'll chat with you guys later. Take care.